If you are looking to put your money to work and earn passive income, then dividend investing can be a great way to get started in the market. It is not, however, as easy as simply buying stock and waiting for your dividends to come in like many believe. There are many different dividend stocks out there, and it's important to understand the differences before you jump into this investment strategy head first. Watch this video all the way through to learn all about how to use dividend investing to earn passive income and start adding those extra dollars to your bank account each month. Hello everyone, welcome back to Fascinating Self. Now, let's get started. Passive income is money that regularly goes into your bank account with little effort on your part, no matter how the market performs. Unlike growth investments, where you're hoping your wealth grows over time, passive income gives you a more stable cash return. Passive investing also will save you from worrying about market volatility and macroeconomic uncertainty, all of which could impact the performance of growth investments directly. Some experts have called passive income an infinite potential income stream because of the myriad of possibilities where you could generate this sort of income. Passive income can come from investments that pay you dividends and interest you earn from your shareholdings. For instance, if you've identified strong investments with dividends that grow by 15%, 20%, or even 25% annually, then the passive income generated from you staying the course longer term with these holdings is probably going to be more than sufficient to sustain your living expenses. That could give you the financial freedom you need to leave your day job or main source of income and pursue other personal dreams if that's what you're aspiring to do. And speaking of these dividend or interest payouts, you can take these payouts in cash, but if you reinvest it instead, you can start to benefit from compound interest as well, a win-win situation for you. Your new dividends and interest will be based on the new total. So every time you reinvest these funds, you may earn more interest and more dividends, allowing you to grow your portfolio balance. Let's explore some examples of passive income you could consider for your investment portfolio, so you may receive steady returns literally even while you sleep. Now that you understand the basics of passive investing, the next question you're probably asking yourself is what passive income ideas to explore. Passive income is typically generated by low volatility investments such as dividend stocks, bonds or certificates of deposit, and life insurance plans. Revenue streams and income flow on these types of investments are relatively stable and more predictable as they're less volatile than other investments. They don't go up and down in price as much. This makes them a relatively stable part of your portfolio. You don't need to spend as much time monitoring them. They're also more suited for long-term investing, so you don't face as much stress over having to time the market accurately, buying when the price is at its absolute lowest and selling at the top. If you're the sort of person who really values peace of mind and who doesn't want to be kept awake at night worrying about market volatility, investments that generate passive income are likely to be a great fit for you. The dividend yield is a good indicator of the return on your investment, similar to the annual rate on a savings account. It is calculated as the dividend payment divided by the price of the stock or investment. So if a company with a stock price of $100 pays a $4 annual dividend, its dividend yield will be 4%. There are three main ways to earn a dividend stream from investments, all of which can be held in an individual stocks and shares savings account without incurring income tax. The first is to hold the stock of a company. Some, but not all corporations pay dividends to their shareholders. Dividends are generally paid in cash on a quarterly or semi-annual basis. Companies may also pay one-time special dividends to return cash to shareholders, for example, after the sale of a business. According to investment firm Janus Henderson, global dividends hit a record high of $1.4 trillion in 2021, and by 2022, that number will be even larger thanks in part to the explosion in dividends paid by mining companies. However, there may be a trade-off between dividend payments and share price growth. Growth stocks such as Tesla, Amazon, and Meta have never paid dividends, preferring to invest excess cash to generate future growth. In comparison, more traditional blue-chip companies tend to pay higher dividends. According to Investors Chronicle, the average dividend yield for the FTSE 100 and NSA DAQ is currently 3.3% and 0.7% respectively. This illustrates the higher proportion of dividend-paying industrial companies in the FTSE 100 compared to the tech-heavy NSA DAQ. However, one should be cautious about very high dividend-yielding stocks, which can occur when the stock price falls sharply, artificially inflating the dividend yield. This means that fundamentals other than dividend yield should also be considered when researching a stock purchase in a company. Number 2, then we have the investment trusts. Investment trusts invest in assets such as shares, and the majority of trusts pay dividends to investors. As with shares, investment trusts have a live trading price which can go up or down depending on demand. The benefit of investment trusts over funds is that they're allowed to retain 15% of annual income to build a rainy day cash reserve, enabling them to maintain consistent dividend payment in market downturns. According to the latest Association of Investment Companies list of dividend heroes, 7 investment trusts have increased their dividends for more than 50 consecutive years. As with shares, dividend yields should be considered alongside other factors if you're looking to buy an investment trust, particularly its future prospects for share price growth. There is a variety of investment trusts from which to choose, including specialist equity income trusts and trusts focused on different sectors such as technology, property, and commodities, along with different geographic regions. Number 3, another way to get a dividend stream from investments is to invest in funds. Funds are similar to investment trusts in that they hold an actively managed portfolio of shares and other assets. However, they don't have a live price and are repriced once a day based on the value of their underlying assets. Although many funds pay an income in addition to capital growth, funds whose primary purpose is to pay an income are found in the UK and global equity income categories. According to investment information provider TrustNet, most U.S. equity income funds currently pay a dividend yield of between 3% to 5%. When buying funds, you may be offered a choice of income or accumulation units. Income units pay dividends in cash to investors. With accumulation units, dividends are used to buy additional units in the fund, providing the opportunity for future capital growth by reinvesting dividends. That's not all, there are many other ways to generate passive income through dividends. Company shares. Lodging your money in a savings account also produces a passive income. Easy access savings accounts are currently paying up to 1.2%, while the leading regular savings accounts offer rates of up to 2%, although these typically have a monthly limit of $100 to $500. It is worth reviewing the interest rate on a regular basis as it may include a limited period bonus rate. You should also check that your account is covered by the Financial Services Compensation Scheme, which protects customers up to $85,000 in the event of the failure of a bank or building society. Although investing in savings accounts is lower risk than the stock market, the average return has also historically been lower. Given the current inflation rate of 7%, money invested in savings accounts paying an interest rate of 1% will be effectively losing 6% in real terms each year. Which brings us to the next way, which is much more profitable: income from property. Investing in property can generate a substantial passive income either from long-term rental or short-term holiday lets. However, this involves a significant upfront investment, as well as ongoing maintenance and management of the property. Property yield is used as a rule of thumb measure for estimating the annual return from property and is calculated as the annual rent divided by the purchase price. According to our research, the average rental yield in the US is 3.6% in 2022. However, rental property can also provide capital upside over a longer term period. Now, although passive income investments are less volatile, just like all investments, there's still a risk that you could lose the money you invest or that you might not have the revenue stream you had expected. There are many reasons for uncertain outcomes. A company you own shares in could be hit by a scandal that causes its stock price to plummet. Political and social events happening all over the world could have an impact on the value of your investment, and even currency fluctuations could affect performance. To optimally manage risk, don't put all of your eggs in one basket. It's a good idea to consider putting your money towards a range of investments in order to diversify your revenue streams. A good example is considering unit trust, where you'll see your investment spread over a number of securities instead of just one. That way, if you lose money on one, it could be balanced out by your other investments. Another way you may mitigate investment risk is to consider including endowment plans in your portfolio. An endowment plan is a type of life insurance that is able to provide guaranteed returns in the form of a lump sum payment even over a short time frame, and yet is less impacted by market volatility, so it's a great way to generate passive investment income for you, without requiring you to constantly worry over how the economy is performing. There are usually different maturity tenors attached to endowment plans, so you can choose the time period that suits your needs best. So folks, this is the end of the video. Let us know in the comments if you want us to make more videos like this. Don't forget to like and share this video if you like it. See you in the next video.